Hey, how's it going, guys? Thank you for joining me on this week's episode of The Real Deal. And this week we're talking about PMI, private mortgage insurance. It's a topic that comes up all the time. It's something that's always been, in the back of somebody's head that's purchasing a house. So traditionally, when you're purchasing a house, for the most part, it's been where the only way to get rid of private mortgage insurance is by putting 20% down. That is the biggest misconception that's out there when it comes to private mortgage insurance. A quick, brief description of what private mortgage insurance is. When you don't have 20% down to put down on a house, traditionally, what would happen is a company would secure the difference, right? So the minimum down is 3.5%. So a company would secure the difference, the extra 16.5%, and you would be responsible for a monthly payment associated with that, which equates to hundreds of dollars per month, depending on the purchase price of the house. And for the most part, traditionally, that was the case up until a couple years ago when lenders started coming out with more, better programs for clients that didn't have quite the 20% down, but still had a decent chunk of change to put money down on a house. That's coming up a lot more frequently now. A lot of my clients that purchased houses like 2 years ago, they have great equity in the house, just not enough to put a full 20% down on a new purchase. But there's still ways to get rid of that PMI without putting that big chunk of change down. So I'm going to run a couple scenarios with you guys and show you guys some of the ways that it would benefit you and how you could do it with as little as money as possible. So let's take a look at, not that guy, that's me. Let's take a look at a $300,000 purchase, for example. A $300,000 purchase, typically with good credit, looking at FHA loan, you're looking at about $1,960 a month, putting down your minimum 3.5% down, which equates to about $10,500. A big chunk of that, $205 a month, is just getting thrown away with this private mortgage insurance, right? So if you can avoid paying that, obviously it's not going towards anything. It's not going towards your principal. It's not even interest. It's just this fee that you have to pay because you don't have that difference to make up. Well, with some of these lenders and some of the options that we have available, let me give you three different scenarios putting just 15%, 10%, and 5% down, and how all three of those would, you would get rid of your PMI that way. So let's start off with 15%, right? Well, actually, let me show you what 20% down would look like on 300 grand. Normally, typically, this is what you would have to do. You put 20% down, PMI goes away, boom, payment drops down 450, 460 bucks, but now you're having to put down 60 grand, right? Which is a lot of money. So let's say you didn't have the full 60, you have some decent equity in your house, and you have, let's say, 45 grand, which is about 15%. So let's say you wanted to do 15% down. Typically, you would still have to have PMI on that private mortgage insurance. So your monthly payment, even though you're putting down 15%, you're still going to be paying $170 a month in PMI. With some of these lenders, the options that we have available, you can prepay your mortgage insurance. Very affordable to do that by switching the loan from FHA to conventional. So to prepay the private mortgage insurance on putting 15% down is only like $1,400. So your down payment, instead of being $45,000, will be $46,400. But then you get rid of that PMI, and that alone right there, I mean, you just saved yourself almost 15 grand in your down payment, and your monthly payment only went up like $30 a month. So that's on 15%. Let's be more conservative. Let's go to 10%. So same scenario, 10%. Now, this one takes a little bit more to pay down, but not much. Instead of paying $1,400, now you have to pay $2,400. So your down payment goes from $45,000 down to $30,000, right? So now you're only having to put $30,000 down, and to prepay that private mortgage insurance is $2,400. So you're going to put down $32,400. Once again, though, you get rid of PMI, your monthly payment is only $1,660. So just, $100 if that, versus having to put $60,000 down. So I just give you guys an example where instead of having to put 60 grand, you can only put $32,000 down, and your monthly payment is only really going to go up like $100, which is insane. Let's take it at another level. Let's just go the absolute lowest amount that you could put down and get rid of PMI. That's 5%. So let's assume that you're going to put 5% down on a house, which is on a $300,000 house, 15 grand, right? So now I just saved you $45,000 on down payment. Typically, once again, 20% down, you had to put 60 grand down. Same scenario, right? Putting 5% down. This time, it's going to take a little bit more to buy down that, prepay that PMI. It's going to take $3,400. But still, you add $3,400 on $15,000. You're still only paying $18,400 instead of 60 grand. And your monthly payment on that would be $1,736. So I just saved you 45 grand, and your monthly payment only went up about $200 versus having to put that full $60,000 down. So that just kind of shows you guys how easy and how very possible it is to get rid of this private mortgage insurance that everybody talks about, that everybody hates, without having to put all your equity, all your money into the house. Now, sometimes in some cases, depending on credit, you might still have to put down a big chunk of change to get rid of PMI. This type of a program does require to have premium credit, so this isn't going to be for everybody. But if you have good credit, you've been working on your credit, and you have some equity from your previous purchase of your home, or you have just some reserves, and you don't want to go into a house putting all that money down. You want to put in as little as possible. You can do that very easily without having to put that big chunk of change down. Otherwise, if you purchase a house and you're paying, that same exact house, $300,000, going FHA, paying PMI, you're paying close to $2,000 a month. You're just throwing money out the door. It would take years for you to get rid of that PMI. It would take either a lot of upgrades, a lot of serious upgrades, and some years of the house progressing over time through, progression of the market value. So just something to consider, something to think about when you guys are considering selling your home and purchasing a new one. Maybe leaving some money aside for, a new car, maybe leaving some money aside for upgrades, updating your house when you guys purchase the new house and stuff. So something to think about, something to consider. I'm definitely excited about that. That's something that I definitely look forward to and helping any future clients with that as well. All right, guys. Well, thanks for joining me on this week's episode of The Real Deal. You guys have a great one and have a happy, safe weekend. Take care.